Are you worried, maybe even confused about what's going on in the economy? Well, today we have an economic strategist, Tom Ciamatis, and he is going to walk us through all these different things going on in the economy. And yes, we're going to talk about how it might affect you.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement podcast. Today is a great day. We're always excited when we get to have a guest to come on and talk to us about the economy. And today we've got a returning guest, Tom Ciamatis. So let me just say this, Tom, before I set this up. Thank you very much for coming and spending some time with us today.
Oh, hey, thanks for having me back, guys. I really love talking to you. And, hopefully we'll have something meaningful to talk about. I think we do.
Yeah. So, here's our goal with this episode. Our goal is to get a perspective that's not just about the stock market. It's about the bigger picture of the economy. And honestly, not even just the big picture of the US, but also worldwide and what's going on in the world and how that might affect what's going on here. And obviously, with what we do, it does kind of come down to how is all of this going to affect our clients or those that might be listening to the show that are worried about these things because they're getting ready for retirement or they're in retirement and all those kind of things. So I think just to get us started, Tom, if you don't mind, here we sit mid of the year, and it's been one of those years. It started off not too pretty. It's come back from not being that bad right now. So could you kind of give us your perspective of what's happened this year, sitting here mid-year of 2025?
Yeah, I think it's interesting in a lot of ways because we've almost managed to cram an entire year into just this past quarter, right? So you had the beginning of the year, there was a lot of optimism in markets about a new administration coming in and it kind of changed the direction. Okay, that always seems to that afterglow always seems to come after an election. Markets were relatively strong in January, right? And that's usually bodes well for the rest of the year. If you have a strong January, I think you have like a 75% chance of having an up year, right? But then as the administration kind of took hold, from an economic standpoint, they started pushing a lot of the stuff that they had talked about in the campaign. I mean, it was no surprise that, Trump likes tariffs and he was going to look to redo deals. I mean, he claims he's a deal maker. And as a result of being a deal maker, he's going to want to make deals, right? But, it kind of hit people like when he finally came out, and it was like right at the beginning of last quarter, when he finally came out, the market was sort of beginning to kind of, turn a little bit as a result of, the rumblings. But on April 2nd, like he came out and he, whipped out that big, sandwich board that said, here's all the people and here's what they're going to pay. And I think that sent a huge shock through the markets because the realization was there like, oh, wow, he's just not talking about it. He's actually potentially doing it, right? And what's interesting about that from my standpoint was that, so I'm a military guy, right? So kind of, I believe in sort of like, things that work and have worked over history, right? And one of the things that, you're taught and was shown to us by people like Julius Caesar and Alexander the Great and Napoleon is you divide and conquer. You don't always have to have more people than the other guy, but you just have to have more people at the right place, right? To defeat one guy and then turn on the other. Well, Trump's approach is kind of like, I'm going to take on the whole world all at once, which is completely contrary to the way I think of it. I would have picked apart Mexico or Canada or, got those guys in the camp and then turned my attention to someone else or the EU or something. So that was kind of a shock, that approach, right? And then obviously we saw what happened, markets collapsed. You saw the treasury market was really alarming, right? And I think that was probably what reeled him in, was at that point, it's like we were on the verge of something really bad. So then you get all of these, pauses and things that went into place. And then, the market had literally, cratered in a week or so. And then when the pauses were announced, the market was like, oh, okay, well, maybe things aren't as bad as they are, et cetera, et cetera. And it started making a comeback. And we've had a pretty remarkable comeback as we're speaking here. I think we're back to all-time records which is bizarre. But yet, in reality, the underlying stuff, I know you talked about the bigger stuff. I don't know that the economy is any better place than it was at the end of the year. I mean, we got a jobs number this morning from ADP that shows negative job growth. So the economy, if anything, appears to be slowing. But I think all the turmoil and all the huff and all the stuff that's been going on has had people reacting. And what I think is more concerning to me going forward is I think we're becoming numb to the outrageous stuff.
Mm-hmm.
I saw an article the other day that they were talking about how, the market is like really complacent. It's like, are we reacting to any kind of potential bad news? And are we risking ourselves at putting ourselves in a place where something genuinely bad happens and we're not prepared to react? So, no harm done, I guess. If you look at the quarter, we kind of started out where we ended up, right? Or where we ended up where we started out. But I think there's just nothing's actually been solved at this point. The economy's not doing great. The market kind of like lost it and came back. We don't have a ton of trade deals. We're still working through this big, beautiful bill. So there's still the potential for a lot of uncertainty, in my opinion, as we enter the second half of the year. I don't think it's just, we kind of, took it, got smacked upside the head in the first half, and now all of a sudden things are going to be smooth sailing for the rest of the year. So I don't know if that encapsulates kind of where we are, where we got to, or if there's anything specifically that we wanted to address. But it just seems like it's been an up and down and all around, and we're kind of right back where we were.
Right. Yeah. Yeah. Optimism with the administration change, and then we all knew that there's gonna be agendas being pushed, but now they're being pushed, which caused reactions, and the degree at which they were being pushed in the tariff side caused heavy reactions in the market. And we had the pause, which created some optimism and some buying opportunities in the market, brought us back up. And so now my question to you, Tom, is we're approaching the end of this 90-day pause. So let's stick with tariffs for a second. The end of this 90-day pause very soon here. What happens next, and where are we at on some of those, I guess, trade deals? Some you'll hear about that seem favorable, and the market reacts to that. And then I know there's still a lot that are under the work. So what happens after this 90-day hold from a tariff perspective, but also the market, and then also maybe what the Fed is thinking in reaction to it?
Yeah, so I think what's going to be interesting is one of the lessons learned from 90 days ago is that you can't be, out in front and bold and kind of bull rush this thing. I think there'll be nuances, where we'll be told that things are progressing, and because people are talking, we don't want to jeopardize talks, and we don't want to, it'll be kind of like that things are kind of simmering in the background. I don't think you're going to have, again, you never know, but I don't think you're going to have a situation where the 90-day period expires and, the sandwich board comes back out and said everybody's back on the old plan. I think a lesson was learned in the way the markets and global markets in general reacted to something like that. So I think, you'll probably have overtures of where we're getting close on this guy, or we're talking to these people, and crumbs will be, put out there. But I think, the question is I need to see, like we had the UK deal, right? I need to see more deals, right? If we start seeing deals, then it's easier to go along with we'll let these things play out. I mean, there has been talk. I think I saw Trump talking the other day. He was saying he just wants to send letters out to everybody about what they're going to pay in tariffs, which I don't know. That's a nice, quaint talking point. I don't know if that'll work in actuality. I think a lot of times we fail as a country to consider the fact that the other side they have a seat at the table. They have a vote, right? Other people have other ideas, and they're not always the ones that we want to push, right? So I think it's going to be hard to get the Europeans or the Chinese or the Indians or anybody else, or the EU to make deals that they find are not. Right now, things are skewed in their favor, right? So why would you want to give away an advantage? So I think that's what we're more apt to see. We're not apt to see like a wholesale slamming of, the brakes again and the tariffs are back, because we know how that worked out. And I don't think Trump is very happy seeing markets, decline precipitously like that. I think he likes talking about a good, strong stock market, but I think we're going to get more sort of, a nuanced approach, micro deals, regional deals. We're working with these guys. We're close with that guy. And I think it's not going to be as quick as it was initially advertised, that we're just going to say this is what we want to do and everyone's just going to collapse and fall in line. Although you look at Canada, I mean, Friday they were told they weren't going to talk to them, and because of that digital tax, and then lo and behold, boom, on Monday they pulled it. So a lot of it just depends on how interdependent some of these countries like Canada and Mexico are in the US. If you look at GDP, we're a significant portion of Canada and Mexico's GDP. So I think we have a lot more leverage there. So those are the deals that probably need to get done sooner than, say, someone like China, who sells a lot to us, but we don't really impact their internal domestic economy.
Yeah.
And so, sorry, a quick follow up to that. So with the Fed, then do they just stay kind of in a wait and see type of pattern, or do you think we get any cuts this year? We're supposed to have a couple, but there's talks around, does that go away?
Yeah, I think right now, as we speak, we got a pretty soft print, a negative print actually on the ADP this morning, right? We have jobs numbers coming out. If you see a deterioration in jobs, I think that paves the way for them to actually start talking about possibly cutting. The problem with Powell's stance right now is he's sitting around and saying, I want to wait and see if tariffs are going to be inflationary. Okay, that may sound plausible to people that maybe don't follow this stuff, but there's a couple of things wrong with that assessment. First off, companies and markets are anticipatory, right? If you're running a company and tariffs are coming, you're going to structure your business model in a way to try to mitigate that, right? You're just not going to sit there and wait till it happens and then say, oh, shoot, I better raise my prices 30% because now there's a tariff. You're trying to, secure supplies, and you're trying to, structure stuff. Where can I cut? What can I do to keep myself competitive? That's one. The other part of it is, in order for you to have inflation, you have to have more money to spend on stuff. So if you have, let's say, $100, and the thing that you used to buy for 20 goes up to 30 because of tariffs, now you don't have 80 to spend on other stuff. You only have 70. So so the logic is that, you're going to have less to spend. So I don't know where the inflation is going to come from, because it would only be inflationary if you spend $10 more on something before, and then somebody gave you an extra $10, so you still had 80 to spend on other stuff. So there's that aspect of it. So I think Powell, in a lot of ways, there's a personality issue with him, with Trump. They don't like each other. Trump's made no bones about it. I think he's just being stubborn in some respects. But I think that, if jobs soften, we may actually see the Fed being forced to move. And, Trump's made no overtures about wanting to get rid of Powell. And the problem with that is, how does the Fed maintain its independence? Because if Powell caves and lowers rates, they're going to say he caved to Trump rather than to the economic data. If he stays pat, you have people like me that are arguing, saying, tariffs are not going to cause the kind of inflation you think it's going to cause, and you're just being obstinate. So he's kind of forced himself into a very bad place, which is unfortunate, because he's kind of like trying to be independent, but he's just, he's surrounded by circumstances that are not good for him.
Well, let's talk just a minute about this tax bill. That we have the name of the big, beautiful bill. I think that's kind of an interesting name too, by the way, because it even makes those that oppose it, if you're going to call it by its name, you have to still say big, beautiful bill. And that hurts a lot of people. Some of them can't really call it the big, beautiful bill. They drop the beautiful part. But either way, what everybody knows, according to the media, is being called the big, beautiful bill. As we sit here today, we are just at very slim margins, but yet it looks like at least there's a chance that this does get passed. So I guess let's just have a conversation. And if you're listening to this and it's already happened, and you kind of got a different viewpoint of whatever occurred. But let's assume that it does narrowly pass and it goes into place. How do you see that playing out? And I guess, and then conversely, if it doesn't, what kind of problems do you see with that? Just, I guess, in some kind of balance of either direction.
Yeah, I think from my standpoint, and again, you're talking about a massive bill, right? And there's going to be components in that bill that people like and people don't like and people agree or disagree with. And it's not I'm not, articulate nor literate enough in what they're putting out. It's a huge, was it like 900 pages,
Mm.
right? So, but what I will say is this, right? One of the things about this is it's been a central piece of the current administration's agenda. And in order for it to move on to do other things and to devote its attention to other matters that it, wants to do, you have to kind of get this settled, right? And if this doesn't get settled, that's going to take away from all the other sort of initiatives that the administration wants to pursue. Now, from a market standpoint, what that does is the markets hate uncertainty. We all can agree on that. And good, bad, or indifferent, or where you sit on this bill, once it's passed, that's a known. There's nothing that can be snuck in there or taken out or done. You know that taxes will not go up at the beginning of next year. So once the market is committed to the fact that this is the way this bill is going to be, and it's a done deal, again, how you feel about it is a personal thing, and you may agree or you may not agree with what's in it or all the components, but from the market standpoint, it's settled. It's done. It's something that we could put behind us. It's like the lines have been drawn on the field, and we're just going to play with where the lines are. Okay. Then what that does is then it allows the market to focus on, okay, based on what all is in this bill, this is what we can expect. So companies can do whatever they need to do, and earnings will be what they will, and so forth and so on. But if it doesn't, all that means is that, okay, all of these Congress people, all of these administration people are going to spin their wheels trying to get a new version of this bill passed. And that's going to take their eye off the ball on other things that they may be wanting to do. And whether that's tariff or domestic stuff or whatever, at the end of the day, you're going to focus on this because this needs to pass. You need to make sure that the debt ceiling is increased and those taxes go away. Because if they don't, those two things right there will be probably one of the worst self-inflicted political economic wounds that you can have. So that's the biggest challenge. Again, without trying to get myopic about what all is in the bill. Like I said, people love stuff in there, people don't. There's going to be opinions, but anytime you put 900 pages together, there's always going to be something that someone likes or dislikes and all that, and that's just the way of things, I guess.
Right. With the tax cuts, but then cuts to certain programs like Medicaid, and then increased spending on the government side, increased spending on the military side. There's been projections made as to what this bill is going to cost us in the long run, and the number keeps coming around, 3 trillion plus being added to the deficit, and that's a big concern for already where we stand in the deficit. So, what are your thoughts on that? By adding another 3 trillion over time, and how does the economy handle that?
Yeah, so from my standpoint, the way I look at it is we're 36 trillion in the hole right now. From the national debt, it's no longer abundantly clear that you can just cut your way to fiscal health. I mean, we've seen, like, look at the fact of the matter is, even this bill, supposedly there's deficit hawks in here, and people that want to cut spending, and the Rand Pauls of the world, and people like that. So the challenge is we're still spending more than we were pre-COVID, and we can't even get spending down to pre-COVID levels. And my question is, what exactly are we getting? We're spending 30%, 40%, 50% more on the federal side. Are our lives 30 to 40, 50% better because of that? did our population grow by 30 to 40 or 50% in the past 5 years? No, but the government just keeps getting bigger and bigger and bigger. And there's this huge challenge to try to rein them in. But if you do that, everyone screams, right? Because everyone's got a pet project or everyone's got, a constituency that they want to be happy and don't cut this. I count on that. So, I mean, you guys just lost a senator, right? He threw in the towel because he didn't want to go along with some of the provisions. I don't know. But at the end of the day, what's challenging is that you can no longer just count on Washington to behave and get budgets and control stuff. So they're going to spend. So now the question is, do you hope or have enough hope that this bill, as Trump promotes, will create the kind of growth where we could raise revenue because more people are working, the economy is getting better? I don't know. That's a huge risk, right? But the downside is that in order for you to not have that $3.3 trillion increase, you'd have to get they're basing that increase based on the fact that the taxes would revert back to where they were, and that would make the 3 trillion go away. And I don't think anybody on the call, regardless of where you are in the political spectrum, wants their taxes to go up that dramatically. So that's the challenge, right? So we're in our own sort of conundrum, right? We can't count on Washington to rein in spending, so we have to figure out a way that we could grow our way out of it. And now we're having to take what Trump is saying, on its merits and say, well, can you grow us out of it? Because I think in the last tax cut package in 2017, that taxes came down, but I guess I've heard from many sources that tax revenues actually went up even with lower taxes. So if we can get those revenues up and growth and people participating in the economy, then we could probably, the way I look at it, the simplest way for folks is think about like when you bought your first house, right? And you had a mortgage on it. Those first few months or first few years were really hard because that mortgage was like, my God, like that's a big chunk. But as you got promoted at work and made a little bit more money, it made handling that mortgage a little bit easier. That's kind of how I would look at it. But we've got to get Washington to stop adding to that 36 trillion at some point. So if you could lock down that $36 trillion mortgage and then grow the economy so that servicing that debt, and we could slowly but surely chip away at it. But, I mean, look, maybe I'm pie in the sky. I don't know how many people would actually you give Washington $1, they spend $1.10. And it's like, I'm afraid if we just raise more tax revenues, there'll be many more good ideas that the politicians want to spend it on. So that's a challenge.
Yeah. So let's do this as we sum up this conversation for this, where we sit. So we sit here again, midway of the year. We've got some unknowns, probably a lot of unknowns. The bill's going to get passed or it's not. We're going to get tariffs or we're not. That's going to either be, we got all these little things that could happen. There's going to be a war or not a war. So we got all these things that are kind of like teetering right now as we sit here mid 2025. If you could just kind of, and I know this is not fair, I'll disclose everyone. I'm asking you just to give us your idea, not that but if you had to kind of say, how do you think 2025 is going to end from here? How do you see it playing out?
So I don't see volatility going away. I see us being continuously tested through the rest of the year. But I think, again, there's a lot of caveats here, right? If you get the tax bill passed, right? Again, are you an optimist, right? I generally think of myself more optimistically than pessimistically. I'm willing to give the administration, the current administration, a chance to prove me, right on the growth that we just talked about, right? Let's hopefully that, energy prices come down. There's an enthusiasm. People get back to work. The lower taxes go, engage in more big business activity and hiring. Okay, I don't know that may not take. This isn't going to happen like the day after it's passed, right? It takes a little bit of time to ramp up. But as that momentum sort of builds, then I'm optimistic that in the second half of the year, we could probably tack on another 10%. But it's going to be challenging because every time somebody says something, I mean, look at Friday, for example, right? Just this past Friday, you had a really good market that was like, adding to a record. And then in the afternoon, we just stopped talking to Canada. And then, we still ended up the day with a record, but it was only a record by like 3 points instead of by like 30 points on the S&P, right? So that's the kind of stuff that you just have to like let run off your back. I think the most important thing is how do you feel during these periods? And I think this is where it's important for you guys to, engage with your clients, and for your clients to understand that they need to engage with you. This investing and how your portfolio is performing should not be a source of stress for you. And I think if you get caught up in the day-to-day news cycle of the ups and the downs, it could be very stressful at a time when you don't really need it. So to me, it's like, look, we're at record highs right now. I think we're still going to tack on another 10% on the U.S. markets the rest of the year. But I also think it's a good time for you to look at where you are. And if you are out of kilter, you need to rebalance, right? You need to get to a place where you're comfortable, because these things should not drive your everyday consciousness, right? You should be enjoying your retirement or whatever else you want to do. And these events are just going to keep coming at you fast and furious. I mean, look at, last week we bombed Iran, and no one's talking about it this week. Like, what's next week going to bring, right? So so if you're wrapped up in that stuff, you need to make sure that from an investment standpoint, that's real stress, right? Because at that point, if you're actually like making bad investment decisions and losing money, it's one thing to just be ticked off at the TV and turn it off and walk away. But to actually make a decision based on what you're seeing in your emotional state, that's a frustrating thing. So I think interest rates, back to your earlier question, without my PSA, let's I think interest rates are going to go down 2 to 3 times. I think Powell is going to be pressured just by events. The economy is slowing. I know we had that negative GDP print in the first quarter, but a lot of that was shenanigans, right? A lot of that was just people pre-buying stuff to try to front run tariffs, and based on the way they calculate GDP, more imports adds negatively because it's not made here, right? So at the end of the day, I think rates probably go down more akin to like three times, so like 75 basis points. So I think if you're in a situation where you could lock in a little bit higher interest rate product now before rates go down, do it. The other thing is I think the earnings were really, really severely like surprised really well, and they were severely projections were depressed. So I think people are going to surprise on the earnings side. I think by the second half of the year, if these things are done, right, the bill and the tariff stuff starts to come in, I think we have a pretty solid close to the year. But it's going to be chunky, right? It's not going to be for the faint of heart. So that's sort of my base case.
All right. Well, we appreciate it very much, Tom. It's always nice to have you on and kind of talk these things through. It's things that are on our listeners' minds. It's on all of our minds. So it's good to talk it through, and we'll see how it is. We'll have you back here at the end of the third quarter, and and we'll see how we are.
Yeah, too bad these things are taped, right? Because people can watch them back to back, and it's
That's
like
right.
literally like, hey, you said what you said. So,
Thanks
All
again,
right.
Tom.
Thank you very
all
much.
right, you guys, take care. Thank you. Talk to you soon. Take care.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.